In this video, I'm going to show you exactly how institutional traders mark supply and demand zones. We'll start with 3 simple steps to draw your zones on any chart. Then I'll share 8 proven rules to spot high probability zones. So, what exactly is supply and demand? To understand this, every strong price move in the market follows a simple 4-step cycle: range, initiation, mitigation, continuation. This cycle shows how price reacts around real supply and demand zones. Using this cycle can be extremely helpful for spotting high-probability trades. Let's walk through 2 chart examples to make it clearer. First, on this chart, you'll notice the price moving sideways. This is called the range. During this time, there's not much movement. The price is just bouncing between support and resistance. But behind the scenes, big traders are quietly setting up their buy positions without moving the price. Then comes the initiation. The price suddenly shoots up with a strong bullish candle, showing us that buyers have entered the market with real power. The area just before this strong move is where we mark the demand zone. That's where the buying started. After that, price pulls back down to revisit the zone. This is the mitigation phase. Institutions might have leftover buy orders from earlier, so when the price comes back to the zone, they fill those orders. If the price touches the zone and bounces back up, it confirms that this demand zone is solid. Finally, we see the price move up again. This is the continuation. The zone held strong, buyers stayed in control, and the trend keeps going. This wraps up the full 4-step cycle, and that demand zone becomes an important level on the chart. Alright, now let's check out what happens when the price drops. First, we get a range. Price moves sideways while big sellers get ready. Then comes the initiation, where price breaks down with a strong bearish move, creating a supply zone. After that, price pulls back to that zone in the mitigation phase, maybe stalls for a bit, then drops again. That shows sellers are still in control. Finally, we see the continuation as the downtrend picks up again, and the whole 4-step cycle plays out. Here's why this works. Institutions, banks, and smart money step in with huge orders that create an imbalance in the market. When price breaks out of a range, it's because these big players are making their move, and that leaves a clear mark on the chart. Looking at the chart, once the price breaks out, it often pulls back to the same level where those buyers stepped in. That's your demand zone. Now, here's the thing. As retail traders, we don't have the power or money to move the market like they do, but we can spot these zones where the big money was active. When price comes back to these areas, there's a good chance those same buyers will jump back in and push the price higher. Most beginner traders miss this part completely. See, the market isn't just random numbers flying up and down. It's driven by people, and people are emotional. Fear, greed, panic. All of that shows up in price. Every candle, every spike, every drop. It's emotion being turned into buy and sell orders. But here's the catch. Institutions don't trade like you and me. They can't just drop a massive order in one go. If they did, they'd move the market too much and ruin their own entry. So what do? They build positions slowly, in pieces, over time. And when they do that, it creates imbalances. Areas where price shoots away fast, leaving behind unfilled orders. That explosive move, that's your signal. That's where something big happened. That's how a supply or demand zone is created. It's not just a random level, it's a footprint. And if you know how to spot it, you'll know exactly where the smart money stepped in. So now you know what supply and demand are, and how they're based on smart money moves. But here's the tricky part. How do we draw these zones the same way every time? Before we jump in, keep this in mind. Your best trades will always line up with market structure. If you're not sure how to read structure, I've got a video on that. Go check it out first. To spot high-probability supply and demand zones, traders focus on 3 main types. Let's start with the first one, range zones. A range zone forms when price moves sideways for a while, staying within a small area. It's a sign that the market is undecided, with neither buyers nor sellers in control. During this time, candles are often small, and price just drifts back and forth. Then, a strong green candle breaks above the top of this area. This shows that buyers have gained strength and are ready to push price higher. The sideways zone now becomes a demand zone, a key area where buyers likely entered the market before the breakout. To mark this zone, draw a box from the lowest point within the range to the highest point just before the breakout. This area often acts as support when price returns, offering a strong place to look for buying opportunities. Supply zones are the opposite of demand zones. Instead of breaking upward, price breaks below the range, showing sellers have taken control. After some sideways movement, a strong red candle drops through the bottom. This creates a range-based supply zone, an area where sellers likely entered before the move down. To mark it, draw a box from the highest candle in the range to the lowest one before the drop. When price returns, it often reacts and falls again, making this a strong area to consider sell trades. Let's talk about pivot demand and supply zones. I'll keep it simple for you. When price is trending down, showing that sellers are in control, something interesting happens. A red candle forms, followed by a strong green candle that closes above the high of the red one. This is a shift. Buyers have stepped in with force, pushing the price up. This is what we call a pivot demand zone, where price changes direction and starts moving higher. To mark this zone, draw a box from the high to the low of the red candle. This red candle is where buyers took control. We can call this a sell-to-buy setup. It happens when a red candle is followed by a strong green candle that closes above the high of the red one, signaling that buyers have overpowered the sellers. For a pivot supply zone, the opposite happens. Price is trending up, showing buyers are in control. Then a green candle forms, followed by a strong red candle closing below its low, signaling sellers have taken control. Draw the zone from the high to the low of the green candle. This is a buy-to-sell setup, where buyers are exhausted and sellers take over. Keep these rules in mind. For a demand zone, the green candle should close above the highs of the previous candles. For a supply zone, the red candle should close below the lows of the previous candles. This confirms a real shift in control. As you practice more, you'll notice ways to improve your zones. Sometimes, one strong candle inside a bigger area becomes the key zone. Think of it like zooming in on an image. You're finding the part that really stands out. These smaller pivot areas can help you place tighter stop losses and get better risk to reward on your trades. Most importantly, stay consistent. Whether you use pivot candles or a specific method, draw your zones the same way each time. This builds confidence and helps you trade with more focus. One of the most important things to show on your chart is how price behavior repeats across different time frames. The market is fractal, which means the same patterns appear on both lower and higher time frames. To visualize this, start with a small range on the 15-minute chart. Let's say it's made up of 4 candles. If you now switch to the 1-hour chart, you'll see those same 4 candles combine into one single candle, often forming a clear pivot zone. That area, which looked like a small range before, now becomes a key decision point on the higher time frame. This simple comparison helps explain why a zone that looks minor on a lower time frame can actually be part of a major zone above, and vice versa. You can literally watch how structure builds from the inside out. Now let's get into 3 fractal patterns you can point out on your chart to get even more precision. The first is the inside bar. An inside bar forms when a candle's high and low stay completely within the range of the previous candle. It might look like low momentum at first glance, but drop down to a lower time frame, and you'll often see it's actually a tight consolidation range. This tiny pause in movement can act as a hidden supply or demand zone, especially if price is building pressure before a breakout. It's a microzone, easy to miss, but powerful when it appears inside a larger structure. The second thing to look for after market structure is wick zones. These show up when price moves quickly into a level and then reverses, leaving a candle with a long wick and a small body. In an uptrend, focus on bullish candles with long lower wicks. That shows strong buying from that level. We call this a sell-to-buy wick. In a downtrend, look for bearish candles with long upper wicks. That shows strong selling, called a buy-to-sell wick. These wicks often show where big moves started, especially on smaller time frames. The third step is wick refinement. Instead of marking the whole candle as your zone, just use the wick. That's usually where the real orders were placed, and it helps you get a better entry with lower risk. You might be wondering, where are the 8 rules for high probability zones? I'll get to that in just a moment, but first, let me ask you this. You know how to draw zones, right? Most traders do, but here's the real question. Do you know how to use market structure to find the right direction when drawing them? Without that understanding, you're setting yourself up for unprofitable trades. That's exactly why it's crucial to focus on high probability zones. And that's what the 8 rules will help you do. So be sure to check out my videos to learn how to spot those zones and make smarter trading decisions.